If I told you that there was a way to pay your line of credit in a way where you never had to worry about the minimum monthly payment, would you believe me? Hey everyone, welcome back to the Velocity channel, where this is your bridge to financial freedom. Listen, today we're going to show you how to pay all of your bills, including knocking out those massive high loans, those cash flow sucking loans, in a very minimal amount of time instead of 6 years, 7 years, 10, 20, 30, 40, 50 years, right? And there is a 50-year plan. I don't want you on it. I want you to make sure that you are out of those debts as quick as possible, in months, not years. All right. So listen, before we get into that, I want you to do something for me. Like, share, and subscribe so that everyone around the world knows the power of Velocity Banking. Now, whether you have a First-Lien HELOC, a credit card, personal line of credit, a business line of credit, a B HELOC, whatever line of credit that you have, it wouldn't matter. I'm going to show you a way to pay these lines of credit that maybe you haven't thought about before. And it's also going to leverage your position financially so that you're able to knock out those loans. All right, are you ready? Let's go ahead and do it. First of all, I go ahead and start with what I usually have, the $10,000. Now, I use the $10,000 as a simple number so that it's easy math for us, okay? Don't want to get things too complicated, all right? I mean, I sure could have used like $2,939.89, but I wanted to make it easy there for us all, okay? So that is our line of credit balance. What I want to share with you today are 4 essential elements to Velocity Banking. First of all, we have the obvious one, which is our line balance, all right? The next one is going to be our cash flow indicator. The reason why that is so important is because you're going to want to know on what scale the loan or the line of credit lies. That way, if you have multiple lines of credit that you need to pay off or multiple loans that you need to pay off, you can pay them off in prioritization. And so here I'm going to go ahead and draw a line graph. It's going to go from 0 to 100. This particular line of credit, $10,000 at the 21%, $500 each and every month. It's pretty low. It's a pretty low efficient line of credit because of the amount, right, that we are shelling out each and every month, which is the $500. So the way to calculate the cash flow indicator is you take the line balance or the loan balance and you divide it by the minimum monthly payment, okay? In this case, it is 20, okay? So that's pretty much in the danger zone. Anything that's from 0 to 50, we regulate as danger, all right? So let's go ahead and put a 20 here. And then we're going to hop over to our loan balance divided by cash flow. Why are we saying that? Well, because we want to make sure that we're out of this in an optimal time. So what you want to do is you want to have a formula that you can automatically go to each and every month that lets you know when you're going to be out of the line of credit balance, okay? So let's just say, for good numbers' sake, let's say it's 2,000, right? Is the cash flow. That's what CF stands for. It's the cash flow. So that's $2,000, right? We're going to put on it what? The line balance, okay? The line of credit balance, which in this case is 10,000. So we're going to go ahead and write out all the zeros, and we're going to show you our velocity term. That's what VT is, all right? So we're going to share with you how we do it. We cross out these zeros, and now we're stuck with 10 divided by 2, which is what? 5 months. Now, 5 months is going to be very important because now we know when the $10,000 is going to be full again. Now, do you have to max out your line of credit? No, you don't. okay? As a matter of fact, I recommend if you're looking at your credit score, remember to be below that 30%, maybe 25%. Maybe you're going to push it and go to 28%. Go ahead and do that. But if you have a cash flow sucking loan that you need to get out of in order to capture that cash flow, I recommend doing that, okay? Why? Well, because credit scores, they go up and they go down, right? Like the sea. And if you're really needing out of that cash flow sucking loan, that $600 a month, $700 a month loan, and you'd rather capture that so that you can place it here and pay off other debts rapidly, I mean, that's something you're going to have to figure out, right? Okay. And matter of fact, let's go ahead and share with you an example of a high dollar monthly payment loan that you can actually pay off, right, while maxing out. I know, listen, while maxing out your line of credit, but I'm going to give it to you to share with you if that's something that you'd want to do or not. Let's go ahead and share with you the loan that we have there. So the good thing about numbers is that you can actually look at them and then decide from a number perspective versus an emotional perspective. So let's go ahead and go over here and see what we have. The $10,000 is completed after the 5 months or so. We went ahead and completed that. So now the $10,000 is replenished. But we do have a $20,000, and you can fill in the blank, whether it's an auto loan, a personal loan. Listen, this is how you pay off all loans, all right? We have the $20,000 at 20%, $743 each and every month. But remember that $743 is not going towards the principal. It's actually getting split up. And on month 1, with your first payment, this is how much is going to the different places. For interest, that's what the I stands for, is interest. Interest is going $333 towards interest, and $410 of the $743 payment each and every month is going towards the principal. So it's not as bad as a mortgage, because of course the mortgage, which is a security, I guess I should say home loan, right? It's not as bad as a home loan because the home loan is front end loaded, but it's still pretty bad, right? That's a lot of your income, your hard-earned income, going towards the bank just for you having to have this loan, all right? So let's change that. Let's deploy, since we do have that $10,000 replenished, let's deploy the $10,000, okay, so that we can have it look like this instead of this, okay? Listen, let me share with you something. This is good for the bank, all right? But it's bad for you, all right? Yeah, so what we want to do here is share with you what this $10,000 did. When you deployed it to the principal of this loan, what you did was you essentially did a time collapse transaction, which means you jumped 19 months into the future to the 20th month. And you said, you know what? All that interest that I was gonna pay doing it the bank's way, doing it the traditional banking way. Remember, TB stands for traditional banking, and TB is a disease. And so we don't want it. What we want to do is get rid of the interest, which is what we did. And so, man, that's over $120, right? 20 something dollars. Wait, like more than that actually, $151. I'm gonna have to edit this out. No, I think I'll keep that in there, man. I'm real, okay? Anyway, $182 from the $333, okay? So we are still paying some interest, but more is going towards our principal, which is exactly what we want. So that after the 5 months is completed, because remember, we still gotta pay the $743 each and every month, right? Right? So we still also, we're using our line of credit as our new checking account. So that's what's paying it down. Do you remember? The $2,000 is paying it down. And then we replenish, right? After the 5 months. And then what do? We hit this remaining balance, which is not going to be 10,000. It's going to be way less, right? And then we're complete with that loan in about 10, 11 months, all right? Simply because we did it the velocity banking way. Now this, to be honest, is a 3-year term, okay? 3-year, they want you out of it in 3 years, which isn't bad, but you got out of it in 11 months. So that's less than a year. Plus, what did you do? You captured all of this interest, okay? Yeah, you captured all of this interest. You guys remember doing this? $151. Now, did you save $151 this month? Well, now you can, all right? By doing things the velocity banking way. So if you need help in any way, want to know anything about this, please let us know. We have a webinar coming up this Tuesday. Oh, it's going to be fire. It's going to be talking about the automated velocity banking system and how you can actually get your own debt elimination plan. I've actually been handing those out. People have been wanting them and I've been doing them. God bless you, and we'll see you in the next video.